I know. Is that like we're planning on coming?
I just saw Mike, so he might come in here. All right, thank you. Hi, everyone. Sorry for being tardy. But I have a new laptop, and I'm not gonna lie to you, I don't really know how to work it. Okay. Can everyone see me or hear me? Can you just like give me a thumbs up or something?
I can hear you and see you.
Perfect. I appreciate you. No, don't want to hit that button. Here we go. Okay. So for mortgage market update, I'm not the host of this, so I can't share the slideshow with you, but I'm gonna just go through it with all of you. Um, and so just so you know what our agenda is, we're going to go over credit score requirements, 50-year mortgages, what factors determine a borrower's rate, where rates are at now, why rates move, affordability, buyer and seller conversations, and like what's next and what to look for in the market. And if you have questions, especially or a comment about something, since I'm going to be looking at the slideshow, if you just unmute yourself, I would appreciate it. And interrupt me. I don't care. So the first thing that we will look at is a 50-year mortgage. Are they the way to go, or are they not the way to go? I personally can look at the market and say that it's not the way to go to overcome the market struggles. And overall, it just is because it's very slow equity buildup, basically very little principal reduction in the early years. Selling or refinance in the first 10 to 20 years is just not helpful to them. I feel like it just will cause more harm than good. And it also just puts the client at a greater vulnerability for market changes. It's just a lot longer exposure for them. And if they do have any issues like regarding income, and or just like if they need to refinance, do a cash out refi, they're just not giving themselves a great opportunity to where they unless there's a huge boost in appreciation, there's just not going to be opportunity for them to make a positive move if they were to lock in on a 50-year mortgage. Hey, Mike. Uh, Outside of those things, if home values were to fall at all, then most of like anyone who would take on a 50-year mortgage, their home would end up being underwater. And so from those perspectives, that's why I'm not a fan of it. And there is just a massive cost, like interest cost to the consumer over time compared to a 30-year mortgage. They end up basically paying anywhere between 2 to 3 times more for the house overall than if you compare it to a 30-year. The only loan program that can currently go beyond a 30 is a USDA loan, but it is done directly through USDA and they will offer a 40-year mortgage. But those have to be done directly through USDA, so it's not something that we offer. And it's very rare, but they essentially are only doing that to help someone qualify due to income, or due to debt to income ratios. But even then, it's really hard for them to do a refi or anything of the sorts if that's the option that they try to take advantage of. Does anyone have any comments, questions about a 50-year mortgage?
I did.
Go.
So, okay, I know there was talks about them, that they are a legit thing now.
They're not official, but it's like I get asked about it at least a few times a week. And it's typically from first-time home buyers who are curious, but also like, hey, does this help me essentially buy more house? And so sure, it could, but then if you're struggling with like affordability today, what does it really look like if you take advantage of that? And if they do introduce them, the interest rates are going to be higher. They're not going to be lower. And then also down payment would probably stay the same, but what they're going to pay over time just doesn't make any sense. And it'd be different if they were offering perks or advantages. Like if they did roll them out, we'll call them in Q1 of next year.
Yeah.
If they rolled it out with lower rates or like lower down payment requirements, those sorts of things, or even if they allowed for some wiggle room on debt to income ratios, then I could see why someone would take advantage of it. But if it's based upon how everything is today, absolutely not. It's not the right move to make. And on your typical, we'll call it $350,000 home or less, you're looking at roughly about $160 to $170 difference in a monthly payment. And if you need that much in savings, you're just not looking at the right properties.
Yeah.
So just give yourself some time and then go back to it on a traditional mortgage. That's how I look at it.
Okay.
Anyone else? Cool. For Freddie and Fannie, removing the minimum credit score requirements, like what does this actually mean? It doesn't mean a whole lot, but it does mean enough to where it is helpful to some, but it's not an equal opportunity thing here. It essentially is saying that, hey, everyone can now technically, based upon removing the minimum credit score of 620, can apply for a conventional loan. Does that mean that everyone is going to get it? No. It is still going to weigh in the credit risk, but it also means that they're just going to look a little bit harder or deeper at the entire credit profile because that is being factored in more and it's not just the score. So what does their full financial picture look like? What does the full credit story essentially tell anyone? But ultimately, it's also looking at a computer. A computer is the one who's initially making that decision. So if they do have late payments or any derogatory things on their credit, where sometimes beforehand on a conventional loan, depending on how recent it is, it just might not have been a factor. If you have something that is, let's say here you missed a credit card payment 6 months ago. It might not love it, but it doesn't mean that, and if your credit score is still high enough, you could still move forward. Now you take the minimum score requirement out of there, it's looking at that missed payment like with a magnifying glass, especially if there's anything additional on there that might not be positive. So while it opens up the door to say, hey, we're no longer having this requirement, it just doesn't mean that it's an equal opportunity thing for everyone to say, hey, I have $100,000, I have put down on this $200,000 home, but if your credit score is a 585, it just doesn't mean that that's still going to work for you. And because why is your score a 585 and what basically caused it to get there? And does it make more sense to actually use that part of that $100,000 to correct some things that are negative on there? And then you can get your score up and go with a different loan program. But like from an agent's perspective, sure, it sounds great, but it just doesn't mean that it's the right move to make for every buyer. Does anyone have questions about that? Or like have your clients brought it up to you or anything? Go.
Can you touch on what the difference in like pricing would look like for someone that maybe they did qualify for a conventional loan at a 590 score versus if they were to look at an FHA loan? What are the differences between those?
It's complete 9-day. So let's just say here, if you have a 590 credit score, and we'll say that you're putting 20% down. Positive is that no, you won't have PMI. That's a positive. Okay. However, loan level pricing for that 590 score compared to on conventional, compared to if they're 590 and they're looking at FHA, for poops and gigs here, they could easily have an interest rate of high sevens conventional, and where FHA, they might only end up with an interest rate of, we'll call it mid to high sixes. So there, I mean, yes, they'll still have the PMI, but just that interest rate difference alone is just not the right move for them to make financially. I wouldn't advise them as their loan officer to move forward on that conventional loan product instead of going with an FHA loan, simply just based upon the total cost over time. It would make more sense if they took advantage of FHA today with that scenario and then get their credit up and those sorts of things and then refinance into a conventional loan. That's how I would approach it.
What if they didn't have 20% down and they did have PMI? Is there a big difference in PMI on those two loans?
It would at least be triple, if not quadruple, on the amount.
Wow.
That's Adam, by the way. And Adam is on my team for those who they're not aware of that. So yeah, he's just being Adam. Yeah.
So let's say you have like almost perfect credit, let's say like over 8.
Mm-hmm.
So is there any advantage of doing an FHA compared to a conventional?
You would get a better interest rate.
That's
it.
the,
What if you're using it for a secondary property or you can't do that?
You can't do that. And so on a secondary property, when it comes down, like our next thing that we're going to talk about is interest rates. And where it does suck is that, and there's no other word to put there, unless you use profanity, is that it does suck because if someone who is like, hey, like I built enough equity in my current home and I want to basically start investing into real estate, that's a beautiful thing. But on the loan side of things, it's just not, because they've caught on, Freddie and Fannie have essentially caught on to the market to know that, hey, at some point, like they're going to start basically generating an additional income from this said property. Even if you are doing it from a second home perspective, you can still short-term lease it, you can Airbnb it. So it's not how it used to be, to where like if someone lived here in Ohio, they may or may not have basically rented it out. Maybe they did go there on multiple trips throughout the year, or, from November till basically part of March, they're just like, that's where we're going to live. And maybe they have family members who travel to that area and they let them stay there and have them, only pay to have the place cleaned up. As humans who work in this field, we get to know those things and basically build that rapport. From a market perspective, they don't care. They know that, hey, we're going to charge you more from an interest rate perspective because you are also now going to make money. And for a second home, you're not using any potential income. They are making an assumption, but they're not using any of that to help make a determination on the loan profile. So interest rates on investment properties, second homes and things, like they're just not ideal. And so like sometimes when you do get a client and they are a little frustrated on it, my first go-to is like, hey, well, if you do own your own current primary residence, how much do you owe on it? What is it worth? Like, if you want to do this, like, does it make sense to start off a little smaller and you can borrow against your primary residence and it's cheaper for you? Does that make sense? Sometimes it does and sometimes it doesn't. Depends on what they're after. Because you don't want to be a dream killer and say like, hey, like this just isn't doable. But 9 times out of 10 on a second home, and on an investment property, you hear all the griping and complaining about the interest rate and the cost of it from day one till closing day. And that's why I say it just sucks, because essentially everyone wants their piece of the American dream pie, and it just costs to get it, unfortunately. Does anyone have questions or anything right now before we move on? We'll go to the next part here. And like a lot of times, no matter what the person is buying, depends on how you want to gauge the conversation. But sometimes people, their first question is like, hey, like, what is my interest rate? Or by law, we are required to basically say, like, interest rates as of today are as low as X, Y, and Z. Just what we have to say. Then once they apply, we're going to give them a rate based upon their credit profile and everything else. So it's not just hey, I was on ABC Bank's website today and I see that their rates are this number. That doesn't necessarily mean that you qualify for that. So that might be where they start. That might be what they are using based upon in the fine print. It's a very clean scenario and says that this person has a credit score of 800, they're putting down 25%, and this, that, and the other. That they can basically market those rates based upon their fine print and the example that they're using. But a phone call in is, a lot of them do basically start off with this. And so you can either charm someone to have them keep going and basically get the application, and then is it close to what they were told or is it different? But then also being able to explain to them why it's different. And it's based upon X, Y, and Z about specifically them. And you can't compare Adam and I and what we have. Like, I've done a loan for him, so like our credit is similar. But like outside of that, like when I bought my house compared to when he just did his, like our down payments were different. And now he does have a really good interest rate. I'm not moving. And so when I bought my house, mine is lower. And so like, but if I was buying the house at the same time, sure, our situations could have been very similar, but also like the down payment would have been a factor. And what he put down on his house helped make a difference for him. And so it's just, when everyone calls their mom, brother, and whoever else and just like, well, they said this and they said that, you can't start your consultation off that way because their situation might be different than yours. So I look at it from that angle, because you don't want to get stuck on the rate piece of it. And everyone does want to know, like, hey, what are rates doing? When are they going to come down? Ideally, I wish we all had that crystal ball to know. But I'm going to walk through like what is actually going to make or break a rate change in our market.
I do think it's important to note. So like when people are seeing those interest rates online, so when they're on like Zillow or Realtor.com and it's taking them to like bank rate, I feel like it's a very popular one where it'll list a bunch of lenders. As long as one person in the country can qualify for that interest rate, they're allowed to advertise it.
Yes.
And most of the time, there is going to be fine print that somewhere in there, it's going to tell them you can get that interest rate with you paying $5,000 to $7,000 to $10,000 in points. People don't look for the fine print. They just see the interest rate on there and they assume that's what interest rates are. And so that always makes that conversation a little bit challenging initially, especially if the client has the expectations that rates are lower than what they really are. But ultimately, it's our job to help explain that to them. And then also the other parts of home buying process of like, okay, great, you might be, because at the end of the day, lenders' rates aren't going to be competitive. Like no one's going to be a whole percent different than another lender. So then it's also, you get into the aspect of what else are you getting with who you're going to choose to work with when it comes to communication, reliability, so on and so forth, which, experienced agents know this, but help like us actually helping purvey that. And also I think it's important too, to when we're having those conversations to also help, the client understand that we work as a team with you guys. And so just as an example, I'm sorry, I'm really cutting off. As an example,
You're good.
I had a client who, they called me and they were gonna go look at a house with a different realtor than the realtor that referred them to me. And they asked me, they're like, hey, what do you think I should do? And I said, look, you were referred to me by so-and-so, but at the end of the day, if you want to have the best experience, that's the person to go with, because my communication with them and back and forth, we're going to help get this deal done for you way better than some random person. So not only that, but if you have a true relationship with the lender that you're referring to, they're going to go to bat for you and help you guys retain and keep those clients and help get them closed.
Yeah, I mean, and even when it comes down to rates, what products and all of that, I personally believe that relationships, especially in today's market, is the most crucial thing to a transaction. And that's between like I call it a team. So like at the end of the day, agent refers a client or to a lender, they refer them to a home inspector. Most of the time, depending on the deal, like the title company that's involved. And if there's anything that goes wrong, the only person that doesn't get hand picked, like, hey, I picked you, Mike, to do X, Y, and Z, is an appraiser. And that is just a random rotation based upon a panel. However, like everyone else in that equation essentially has been hand selected to be placed on that team. And if you communicate the value of your team, a lot of times, 9 times out of 10, like you don't have to worry about someone getting frustrated or feeling like they need to go shop lenders, or you don't have a crapshoot a home inspection. You don't have to deal with a lot of it because there's rapport built, there's trust, and again, like it's one team that is essentially going to help this person see this through, and reminding the client that they are also part of the team. Like at that point, they are the captain of the team. If they picked you and then from there they made you co-captain to help select the other people on the team, it is just like the value on that piece in this market is what I see like as one of the most important foundational pieces to it, because they can select their bank to go with, and if something goes wrong, sometimes you have to remind them that like, hey, like that wasn't my choice, like that was a choice that you made, and now I can help you work through it because I'm still on your team. And even if the title company, lender, whoever that you select, if there's an issue that comes up at that point, everyone has already built that foundation together, and you can approach whatever issue that is there on the table as a team. I can say that Shonda Davis and I just had a client who closed last week. And from the very beginning, he said, hey, like Shonda knows, likes, and trusts you. She said that this is like, you are her guy. So you're going to be my guy. Did we have issues? And the biggest issue was the difference between approaching it from like a real true from his financial piece of it, of saying like, hey, how do we make best use of X, Y, and Z? What makes the most sense for you? And how do you do this? At the beginning, he could not grasp that. His biggest thing was, hey, like, well, he's never applied with his personal bank, but this is the rate that that the teller told him one day of what it should be. My rate was different. And so like we had this back and forth thing, and we obviously overcame it. And I will be very honest, I am very shocked that when I looked and I saw that he left me a 5-star review, I was like, holy hell, I didn't even know if that was even going to happen. But even to the day of closing, he would say, hey, yes, I'm grateful for you, thank you, but like, my bank said this. Well, I can't overcome that if you, and he goes to his bank often. So like if that conversation is still happening every single time that he and I talk, it's going to be a challenge. The difference is that Shonda and I were literally one band, one sound, and basically executed the same message every single time. And if we got stuck on something, we would have a sidebar conversation and then go back to him just to make sure that, hey, like we are pushing this value back to you on basically what we can do for you as your team. And so like, it was great. but it's something that can happen, especially when you are working with someone who obviously frequently visits their bank and their bank is communicating one thing and has no idea about what he's doing. They don't know anything about it, and he never applied with them. So that's where it's like, I could have easily been, I don't know, a little sloppy and said the wrong thing, bless you, and or done something to essentially upset him, which could have then thrown the deal off track. But then where you go back to your relationships, it's like, I wouldn't want to do this not only to risk a deal for myself, but I'm also not going to do that for a friend and a referral partner of mine. So we had to collaborate to make sure that it was all being done and said the same way to him. So we will go to our next part of just truly like all the things that really factor in to determine a borrower's real rate. It is credit score, loan to value, which is the down payment, debt to income ratio, property type. So there is a difference between like a single family, a condo, and a multifamily. And townhomes, however, are like, they're the same as a single family rate, and which is nice, but like you have to make sure that it says that it's a townhome. But a condo, your interest rates can easily be 0.25% higher than whatever the rate would have been if it were on a single family house. Same way for a multifamily, unless they're using down payment assistance, and then it's the same. But like we said earlier, the whole occupancy thing, if it is a primary residence, second home, or an investment property, their loan purpose, is it a purchase, cash out refi, or rate and term? Your best interest rate that you will get is as a purchase. That's just what it is. Cash out refi, they're always going to roughly be, we'll say like about 0.5% higher. Rate and term, it can be anywhere from 1/8 to 1/4, just kind of depends on like exactly what we're doing. First time home buyers do get loan level price adjustments. And also then whether or not if someone is comfortable paying points. Most people are not okay with paying points, which I don't blame them. But then if they're looking for something specific, which takes us to like the next part, most buyers are not necessarily rate driven. They're not total cash out of pocket driven to an extent. They are more so payment driven. And so we could also look at it and say, hey, like how does rate pricing get better? If they took away loan level price adjustments on how that factors into rates, and if they took away property type, you would actually see a ton more transactions. You just would, because they would advertise rates differently. It would open up at least a good, I don't know, I would say 15 to 20% more in buyers. And possibly, like I would also say sellers, just because that's going to be a factor there for them, especially for the ones who don't have all of their boxes checked out. Because if you have the rate difference between someone who is a 720 compared to someone who is a 741, it's at least 0.5%. And to them, they would say that 720 score, they would say, hey, I have really good credit, which they do. You can't take that away from them. But at some point along the way, whether they just don't have enough history or there was an oversight on something got missed on that side of it. But if you are a 720 today, and if it's a history issue, you can't make up that time. Like, so whatever you have on there, most of the time it's either maybe a simple credit card, a couple of student loans, or maybe a car payment. But a lot of times, like, it really is, I have a kid right now who just applied and he has a 719 as his middle score, but he only has one credit card and it has a $5,000 credit limit, and he owes like $300 and some odd on it. Is that credit score real? Is it strong? No, he's only 20 years old. So like and because he has a large down payment, he can go conventional, but he essentially has only had this credit card, I think, for maybe a little over a year. So there's not anything to go off of other than, hey, like you've done well by your credit card. So his loan level pricing, he gets some positives because, and where it would have had negatives only because he is a first time home buyer. His loan to value is different, and because he's getting a gift from his grandparents. And so like that, those things help him. And he also, because of his income, he qualifies for Home Ready, Home Possible, which means that his income is under 80% of the area median income. That makes a difference. So in his case, based upon his picture, he is going to get a better interest rate than the person who is at a 745 and putting 5% down. Just based upon all the boxes that check out for him, even though there's limited history. But if he was putting down the same down payment, just because as a first time home buyer and the 745 as a second time home buyer, their rates could be very close to the same, if not the same. But everyone wants a deal and what advantages and what perks are going to be in it for them. But it really just depends on what you're after. And so I look at it from, hey, you have all these things that factor into your interest rate. But if you tell me that, hey, I don't want to spend above X number and I don't want to be out of pocket Y, I'm going to tailor your pre-approval, everything around that. So I ask people all the time, have you ever been to a tailor? Have you ever had something customized for you specifically? Because essentially that's what this looks like. And sometimes they say yes, sometimes they laugh and say, heck no. And I just am like, okay, well, here's going to be your experience of actually getting a customized opportunity for you specifically. Wildly enough, it just happens to be on one of the biggest purchases that you will ever have in your life. But that's what we're going to do. And that's how we do it. And they appreciate it because sometimes, like, if you have someone who says, like, hey, I have $50,000, and they might look at it and say, that's what I want to put down. But you just can't, that you have closing costs, you have other things. And so how do you tailor that to still give them their win? And it's what you just essentially have to do.
I feel like this could be helpful to some agents. So you mentioned that condos come with higher interest rates.
Yeah.
So why is that? And then why are some condo associations not financeable, whether it's conventional, VA, FHA? How does that work?
So it is not, they will have higher interest rates because most condos are attached to another unit essentially. And from a mortgage perspective, you are asking them to, yes, finance your unit. However, if something happens we'll say you're in unit C, but if something happens in unit B next door to you that would cause damage to unit C, the one that you were after, is insurance going to help take care of it and things like that? Yes. However, it's just at a higher risk. You cannot be responsible for what happens inside unit B. So that is a big factor of it. And if it is considered a villa that is like standalone, that is also sometimes can be frustrating, just because you're just like, hey, like this is a standalone house, and which it is, but for whatever reason on how it was built, it got classified as for coding reasons and whatnot. I'm not a builder, so whatever they have to follow to say, hey, like this is why this is set up this way, it classifies as this. And so you do have that hurdle. But the main thing is based upon the fact that it's attached to another unit and the risk level that it proposes. And what was the other part of your question?
Why are some properties, condo properties, financeable, whether it's conventional, VA, or FHA?
It all comes down to insurance. And whether or not, like if they have, what is it? What 75% has to be? Yeah. So 75% of any of the properties within the condo association have to be owner occupied, and if they are leased, and that can basically also propose a risk because it says that, hey, like you allow more investors than you do, someone who's going to actually occupy And sometimes it just happens that way over time, and it happens outside of like a HOA's control. So it's not like it's an intentional thing that happens. But how an HOA looks at it, they're not checking mortgage guidelines to make sure that, hey, like this can still stay this way or proposed to another. Now, FHA is going to have your same requirements as you normally would for like a single family house. And depending on how they were built or how old they are, the majority of condos in Ohio are not approved to be FHA. They're just not. USDA doesn't allow them, and VA, every single VA condo, essentially it's approved like a spot approval. Like, so if anyone has ever asked for a spot approval on a condo, that's what VA is. And their biggest thing is the owner occupancy. And then it comes down to the HOA's budget, their quarterly meetings, the amount that they have in reserves in the HOA's bank account, essentially, and their master policy of saying that, hey, like they cover almost 2.5 times of whatever the value is. So like when you look at it from that angle, they want to make sure that the veteran is essentially not going to be screwed. Just like if they do approve it for most condos who, if you go VA, the insurance that is like required, it's very minimal. And like I have a girl who's buying a condo right now. I think her annual premium is like $300 for her insurance. And that was even more than what the insurance agent advised her to do, because the HOA covers essentially windows out. And because how the garages are, they also cover the garage. So she's only responsible for the walls and anything inside, but like they do the roof and all sorts of things to basically protect them, which is nice. And where she's buying her condo at, it is approved, but it is not approved FHA, because she was on the fence on which one she wanted to go with. But then her parents gave her a nice gift and she said that she was fine with conventional. But if she was an FHA buyer, we wouldn't have been able to say yes for her to proceed with that option.
If I had a client that was pre-approved for both of those, what would be the easiest, fastest way to be able to find out if the condo that they're looking at is approved for their financing that they're approved for?
Well, for FHA, we go to HUD.FHA.or/condos. If you want to know it, I can email it to you. But you go to their website and it'll tell you whether or not essentially the condo is approved. It'll also tell you if it was once approved, if it expired. It'll tell you all of that. Now, for a conventional loan, we have a condo desk that we can ask if it is approved or not. But also, like, let's just say if your person is already under contract and now Freddie and Fannie they're smart enough to where it'll automatically say if the condo is approved or not. And it's through their CPM system. And it'll just basically tell you what additional documents that you need to get from the HOA to make sure that they're still up to code to make sure that it can stay approved.
So what you're saying is I can just send the address to my referral partner lender and they can help me make sure?
Yes, that can happen. Or you can also, like, I don't know, I have agents to where like they want the website, but you also, if you're on the website, you have to be very specific. Sometimes it doesn't show up. There is, I don't want to like blast a subdivision. How do I want to word this? There is a subdivision in Hartville, okay, and their units are not approved FHA. However, they are approved conventional and they are approved for VA for the ones that I have done. Their reasoning for not wanting to be approved for FHA from a association perspective is they don't want to do the paperwork, which is wild to me because I've done 5 VA loans in this area and it's the same paperwork. So you would just think that it would be done, but it's not that way. There's another one in like Hartville, Uniontown area, and that one is a little tricky because if you are on the website, it'll ask if you want to search by zip code, city, condo name, condo ID, state, those sorts of things. Where they're located, it's actually, they have like a blanket approval over several of their like HOAs, but it's actually not under the Uniontown, it's under their main one that's out of Medina. And if you don't know what you're looking for, you won't find it. So that's where, like, yes, it is helpful if someone sends the address to the lender and just say, hey, can you tell me if this qualifies or not? But from an agent perspective, look at if you have a VA buyer who wants a condo, you're just looking at it like you would normally look at to see if a property is going to pass or not pass for VA. And that's how you approach it, because there's no right or wrong way to look at it, because there's just no guarantee. Because it's essentially once they complete the condo questionnaire, they turn in all their documentation, that gets sent over to essentially the VA underwriter. They fill it out how they need to, and then they basically submit it to the VA, and it says either approved or they ask more questions, or based upon what was provided, they say no. So it's not really up to the lender. There's no overlays on that with the lender. It's all subject to the VA.
Thank you. That's all my questions.
Yeah, it's okay.
I just figured it was helpful.
He's like my little brother, gang. Now I got asked this question this morning. The rate cut that happened like a week ago, did it make an impact in the market? Yes and no. So what needs to happen in our market to see real positive impacts in rates is going to be based upon one or two ways to look at this. We could have a huge positive shift in employment, or we need a lot of companies, like heavy hitters, to go belly up, do a ton of layoffs, and essentially go bankrupt. If you want a real positive shift in rates, you would easily see if we turned on the news and it said these 15 Fortune 500, companies are now all closing, they're bankrupt, they've done, 500,000 in layoffs. I guarantee you a few hours later, mortgage rates, you're going to see that they have dropped. And because the world has to make the money from somewhere. And so you can see that. You can also look at it from the perspective of inflation has to be able to cool off completely and stay consistently cool. And so it can't keep fluctuating like it's been, to where some weeks and months that you'll see like, hey, like it looks like we're trending down. And then all of a sudden it's like, okay, well now we're at a 4.6, and it's just, you want it to basically, if it can get and stay below, we'll even call it like a 3.9, you can see some positive, healthy shifts there. So because like by the Fed essentially saying that, hey, yes, they're cutting by another quarter, that doesn't do much to the market from a lender perspective, because they would need, in total, we need 100 basis points. So what that looks like is that you need almost a full percent. So if the Fed is saying that rates are 6.3, you need their rate to actually, what it costs to invest, at a 5.3 if you want to see some crazy shift. And so like this quarter here, quarter there, it's not helping the day-to-day consumer when they are watching the news and they say, hey, like rates got cut. Well, they didn't. Like, not really. And I would say, I would hope that at some point in 2026, whether that's Q1, Q2, that we do see some form of, even if they went down to high fives, it would basically help bring a lot of people into the market from seller and buyer perspective and feel like they are getting a net tangible win on whatever they're choosing to invest in. And so, and if that meant that from just the normal person who's looking to buy their next primary residence, if rates were there, and if for an investment property, if those rates were mid sixes, it would really help change a few things. And like, because at that point, they're looking at they're if they're truly investors, they're doing a real cost analysis. What are my pros? What are my cons? Is this investment worth it in order for me to say yes to this property, however many properties? Like I have a client who was in California and she loved our price points, which is great. However, after 5 deals, she's like, I can't keep paying this higher interest on these homes, especially when you're looking at homes that are 150 or less. It's not adding up for especially what she's able to charge in rent and because of where they're located. So she's like, I need some real gain here. And she's not interested in paying points. And I don't blame her, especially at those price points. It's just like, you have 5 now, let the market cool and see what happens. And as long as they keep appreciating and where they're located, they should, you then come back to me and we'll basically pick back up where we left off with a better rate for you. So I look at it from that angle. But that's where you want rates to be at. I also say that where rates currently are is a very healthy market, but to a consumer, it's not. And the reason on why it's not is because people aren't getting raises the way that they used to. So like some companies are giving raises out of a slight cost of living adjustment, but we also have more self-employed consumers than we pretty much have ever had. And so you guys know you are self-employed. And so you don't always know when your next paycheck is coming. And so you have to spend your money a little more wisely than the person who knows that they get a paycheck every 2 weeks faithfully and their salary, they know what that check is going to be. Your paycheck today could be completely different 2 weeks from now. And so like you have to be smarter. And so you don't necessarily get a raise. And if you do, that raise is because you've done more business. Outside of that, just not how it goes. So most companies where they might have done a 3 to 7% annual raise increase, depending on what type of work you do, that has gone down to where it's somewhere between 1 to 5. And that's a big difference for a lot of people. And it just, from that angle, you can see it, but also the cost of what it costs to live anymore is just continuing to get more expensive. So not only does that also would need to change, but if rates came down and help offset that, you would see like those same people in the market and they wouldn't question it because they're just like, I was just spending X amount of dollars here and now I can basically do the same thing. Even from like an example of like most people used to say that I'm paying this amount in rent. I'm okay with this if I'm going to buy a house. That conversation is completely different now, to where sometimes the mortgage payment is more. But the difference is that can you explain to them that, hey, you're building equity, you're doing all of these positive things for you, and it's an investment to help them understand and also like appreciate the value in that compared to saving the $100 that they are paying less now in rent. Anything that you want to add to that?
That's pretty good.
Oh, I just love and hate this kid so much, guys. I love him more than I hate him. Let me see something here.
It's nothing hostile. It really is.
It's not. It's healthy. I pretty much answer I like operate from a pretty woman perspective. Like when she says no, she doesn't want to be at their beck and call. I am at their beck and call. Um, let's see here. I will mention this when it comes to rates. Do not follow mortgage rate experts on what their prediction is going to be. You can ask him on how many times that like they will say, I've never heard one to be right. That's what I can say. Like they say that they're going to be X and then, oh wait, like that's not what I meant. And like, these things happen. Well, you're not Jesus. You don't have a crystal ball. Like you can't you can't do it. There's no way to gauge it other than knowing if they know information, especially like, hey, like there's X amount of jobs coming to the market, there's X amount of layoffs coming to make that real impact. Sure, they know it, but they're not telling us that that's what they know. They're just making a prediction. So from that angle, like I look at it like they're just FOS, and you can insert whatever letters that you want to put there, but that's what they are. So I don't tell anyone to follow that, especially like if you have someone who does like to do things and like they have a ton of money, but they just don't. They're just like, hey, I'm holding out because I was watching the news and this is what they told me to do. Okay, well, you can keep holding out because they cannot confirm. And like I had this guy yesterday and he was like, I'm only doing what my wife told me to do. So I know the answer is no, but I just need for her to be able to see in my call log that I called you to confirm what I already know, that rates have not gone down for it to make sense for them to do a refi. But what she wants is she wants a rate in the fours. What their current rate is as right now is a 5.99. Exactly. It's a good rate and like they're comfortable with the payment. Like they can still live their normal day to day. And those are like, that's how you win in this market, is like having strong foundation with your team, whoever that is on that team. But then also making sure that the client can see the value and like know that it's coming their way for it to be tangible to them, that we're making best use of their cash. We're making sure that the payment is affordable for them. And like the rate and what's happening in the market and like what's happening with inventory and things like that, it just doesn't always apply to them. Do you like who you're working with? Can you make sure that whoever you have selected can get you to where you need to be financially, but also can you find the home that makes the most sense for you today? Like if all of those boxes get checked, everything else is just background noise. It truly is. And if you build that rapport, it works out as a win every single time. And it's proof. I see it every single day, to where when people don't want to listen and then they end up coming back and like, I'm just like, hey, I don't want to say I told you so, but like, you're not going to go and get it somewhere else. And those, like from a big picture perspective, no one's going to know when these things are going to change. We can't automatically say like all of these sellers are going to put their homes on the market. New development communities and things like that, homes are still being built, and which is very helpful to anyone who currently owns a house and is on the fence about putting their home on the market. There is a subdivision in Hartville, and they are building 121 homes in that area, and on the low end on a value is mid sixes. So like that's great for anyone within a mile distance of them. And that doesn't matter if you live in a crappy house or you lived in the freaking Taj Mahal. Like that's great for them. So there's more positives that are happening than, hey, like there's just inventory is low, things are sitting longer, winter rates coming down. just build good rapport and show your value, and making sure whoever's on your team can also be confident and show their value, and you'll win a heck of a lot more. And if you don't have questions, that's essentially it. But do you have questions? Anyone, even anyone on Zoom? Yeah.
These 120 houses you're talking about, are they putting those where they tried rezoning to build hundreds of condos? Or is that something else that would be paid for?
I can just say that it backs up to 619, and they're not going to add another entrance or exit to this subdivision.
Okay.
So that's all I can say. What's that?
Yeah, no, I know. The one that, it's on the, Mogador Road.
I can't say.
That's fine. Also, you had mentioned, your like length of credit history factoring into your credit score. For like a younger first time home buyer, what would you recommend, at least a minimum amount of credit history?
It's tricky because like FHA, they can be more, you can be more lenient. And, or even if you have a younger borrower who is, let's just say here, they just are recently came back from deployment and they qualify for VA. That's also very different. If you have someone who is wanting and needing to be conventional, I would say that anything that's on there, it just would have to be positive. That's what's going to work better for them. So I've approved loans that have had a really mainly government loans like FHA and whatnot. But like if they've only had a credit card on their report for 90 days, I can get that approved. But if it is conventional, sometimes it is just a little bit harder. So, and if they have, we'll just say here, one credit card, like the kid that I'm working with, if he had that one credit card, and let's just say here, it had a $500 credit limit and he had his balance of 3 something, no go. Like it's not long enough and his utilization is too high. So it's about the whole picture, not just like the little snippet, because if that were the case, let's just say here, if he has a girlfriend. So like, let's just say here, he just bought her a Christmas gift and he paid it off, but the credit report didn't catch it in time. But then like with a conversation, and I could just say, hey, I see this on here, and he could just say, oh man, like that, I bought my girlfriend a Christmas gift and like, but I already paid it off. Okay, well, that's good. Like I can work with that because that's going to make enough of a difference to where it'll basically put us back on course and not make us do something that he might not be comfortable with. So you play your cards right, depending on what the picture looks like. Yeah.
Question. So let's say you have a credit card for like 23 years and you don't like it because it doesn't give you any points. And your next credit card is like, I don't know,
5%, maybe.
like 5 years later.
Yeah.
So let's say it's like 18 years. So if I drop the 23-year standing credit card, would that affect my
Yes.
credit?
Yes, but do you have an annual fee on it?
And I don't use it. I'm just literally keeping it around.
I would tell you, if you don't plan on buying anything or like applying for any new credit for like the next year, really like 6 months, let it go. I'm in a similar situation. I've had this Capital One credit card and I've had it I'm 36. Yeah. So I've had it since I was 16, and I complain about it, I don't know, every freaking month. And so like my wife was just like, let it go. And it's like, I didn't get another credit card until I was in like my mid-20s. So it's like, I don't want to do that yet. And she's like, well, what are we buying? And it's like, I don't know yet. Like, I don't know. And because I don't know, like, I'm afraid to get rid of it because the annual fee on it, it's like $250. And she's like, well, she always says, we're not destitute. Like, just pay the $250, let the card go, and call it a day. But I don't know, call me a chicken. I'm not ready to let it go yet. Yeah.
I hate to lose that. Here's some history for you.
I'm pretty sure length of time of accounts account for like 10% of your score.
It does,
So
but
it's a very small percentage of what your
But then it
score
also reduces the amount of credit that you
limit. Yeah,
Yeah.
limits would also be a factor.
Yeah.
Decent credit line on it, but I just put this sucker in the safe and I don't even.
Yeah, I mean, because like that's the other thing is that like I had we used to work at this credit union and I just basically ignored it. The fact that they were just like, hey, you need to use this, you need to use it, you need to use it. And I didn't. Like I didn't have any reason. And then like they did send me a card that then started earning rewards or whatever. And I still didn't use it. And then I went there the other day to go deposit money into my kid's savings account. And I was like, hey, like, can I order a new credit card? And she was like, you can apply. And I was like, what the heck do you mean? Like, I have one. And she's like, no, like, it actually, they closed it literally like a year and a half ago. I just didn't pay it any attention. And now from that angle, I haven't noticed a difference, but it also isn't like a newer, I mean, it's not an old enough card. I think it would have, yeah, my son's getting ready to be 8. So it might be like 8 or 9 years old. So at that point, it's just like, okay, well, it didn't make an impact that I was able to notice. So you could easily just let it go because it is just that little bit. But because you have such a high limit on that, a lot of your other credit, any revolving credit is essentially established from that one card. So the choice is yours.
So I'm just looking on the bank. Bear with me, let's say this. They say credit history is a high impact. Payment history is a very high impact. But I would say keep it.
I mean, does that hurt me that I don't use it?
No.
Other than they might drop me one day.
Yeah. And so like now that is where, as long as you don't have a balance on it, and even if it's your annual fee, you just have to be mindful of that. And other than that, like you just, whenever you are ready, like if you get a card, we'll just say here that reaches 20 years old, let it go and call it a day.
One's 20 years old.
More.
Yeah.
Cause I got it while I was a freshman in college.
Okay.
So.
There you go. Anyone else?
I've got a question from Zoomland. Can you hear me?
I can hear you.
All right, I got a brand new buyer inquiry last night. She's retired, FHA, pre-approved for 140. Now, she's interested in buying a duplex.
Okay.
Well, when you buy a duplex, all of a sudden you're getting income.
Mm-hmm.
So her income right now is X. A year ago, it's going to be X plus rental income. So my question is, once that rental income is established, are there going to be some refi opportunities opening up to her that she doesn't necessarily have now?
Well, I would say that is if her lender knows that she is buying a multifamily unit, they should be using market rate rent at 75% to help her actually have a higher buying power.
Okay.
So that should be number one. And now if they already are using that and that's what got her to the 140, let's just say if she started at 100, that got her to 140, beautiful. Now, when it comes down to refining, depends on what path she would go. There's not going to be too many advantages, but she can use that to help offset her like mortgage payment and whatnot, to where if she wanted to buy another property or if she wanted to do that refi to just basically get a better interest rate. So she could easily do those things. So there are some positive factors to it, but if it were me, I would make sure that you guys are already exploring her real buying power based upon using 75% of market rate rent.
Okay.
Anyone else? Christine, I cannot believe you don't have a question. If you were here in person, you always have a question for us. And now you just don't even want to talk to us. But it's okay. Maybe you're on the phone, Christine. But if no one else has any questions, I hope that you guys all enjoy your holidays. And if you need anything from us, let us know. I will send you that link. I will not forget. Other than that, yeah, just enjoy your holiday season and let us know if you need us.
Thank you so much.
Thank you.